Mayuresh Joshi, fund manager, Angel Broking, joins us on the show. Good afternoon, Mayuresh. It's good to have you on the show. Let's start off with your near-term view of the Nifty. We've spoken about this before, that we are now entering into the second half and possibly the worst half of the earnings, where debt-heavy infra companies will be reporting. There are event risks surrounding the month of June, which happen to be the possibility of the Fed rate hike, as also something like the Brexit vote that may or may not materialize. But take us through how the setup is going ahead for the June series.
Hi, afternoon. If you look at what the global setup is, I think all the factors and conditions that you've mentioned will take a toll in terms of volatility in the markets continuing. But for the larger part, I think what happens with Brexit, what happens with the Fed decision, will take a bearing initially on how the currencies will react, specifically in the emerging pack. India is far more resilient so far. And again, I think if there is some amount of weakness because of any uncertainties because of the event, you might have some amount of volatility creep in, both on the currency front as well as on the riskier assets like equities. On the domestic front, what largely happens with the monsoon over the next few weeks is going to be a key trigger point for the markets. And yes, as far as the earnings season that has panned out, I think the first half has been encouraging in terms of the broad-based recovery that we've probably witnessed across sectors. But again, I think a lot of the infra-stroke PSU, larger banks, which are probably expected to come through, are expected to have a soft quarter going forward. So again, I think earnings recovery expected to be by the second half, capex recovery by the second half. But largely, I think the monsoons will be a key trigger domestically. What happens on the global scale will also have a bearing. So my own sense is that the market's moving in a range, at least till we see one of these trigger points either fading away and monsoons probably getting better as the season progresses. And earnings, as I said earlier, are expected to revive only by the second half.
Right. Mayuresh, let's talk about public sector banks. I mean, we've spoken ad nauseum about this, but it's important. We will have SBI in the next week also. What is your expectation from the overall PSB pack? We've seen an atrocious set of numbers, but possibly it's a good thing that they're providing over and above the AQR requirement. But even at the index level, the Bank Nifty has been really pressured. We've fallen 700 points from the high that we saw at the end of last month. And going ahead, there are indications of, greater short rollovers happening for the Bank Nifty as well, as also the introduction of the weekly contracts, which is likely to bring in some volatility. Let's start with your view at the index level for starters.
No, again, I think I don't track the index level so closely, but yes, if you ask me what the future prospects for a lot of these PSU banks look like, I think as per the management commentaries, the softness probably is expected on both counts on what happens with the AQR provisioning for this quarter and what comes out of the restructured pipeline, specifically the SMA2 book. So clearly the softness is expected to continue, both in terms of how the asset quality will pan out, at least for Q1, Q2 of the next fiscal as well. But again, I think the higher provisioning is a precursor to what the banks probably are expecting in terms of the working capital constraints still remaining on the balance sheet of a lot of end-user companies, and it's not going to fade away so soon and so shortly. So I think the pains in terms of asset quality pressures might continue at least for the first half of the current fiscal. I think the second half is probably when we might see some amount of cyclical recovery come through. That too, again, I think it is based on a couple of factors: how credit growth will pan out. Secondly, I think how the capex recovery happens based on what government spending takes place, which will again have a bearing in terms of how the expected earnings are expected to pan out. For a whole host of mid-cap PSU banks, I think capital adequacy is also an issue. So I think you need to be extremely selective, specifically on the PSU pack when it comes to earnings growth. But largely, I think the first half is still expected to be soft and tepid for a whole host of these PSU banks.
Right. In your pecking order, Mayuresh, and extending from this discussion, where do NBFCs stand? What would some of your preferred bets be in that pack?
So again, I think NBFCs largely you need to divide it in two packs. One, I think the housing finance companies, and two, I think companies which are catering to the rural spending, rural financing theme. A whole host of the rural financing companies have done well this quarter round, based both on expectations of good monsoons expected to come through, which will reduce the stress on both their asset quality pressures as well as an increasing amount of advanced growth taking place. But again, I think it's a preemptive move that a lot of these stocks have done. So I think one really needs to be very, very selective, because the kind of provisioning that they are also catering to, I think they're moving on to a lower bucket in terms of provisioning that has adhered to gross assets in terms of GNPAs and NNPAs actually staying at elevated levels. And it's the monsoon which can be a deciding factor. If the monsoons are much better than what one really expects, the asset quality pressure should start easing on the balance sheets in the second half. On the NBFC part, on the housing finance side, again, the cost of funds are slowly coming down as RBI starts cutting rates going into FY17, FY18. The cost of funds coming down, the yields probably remaining stable, asset quality pressures remaining stable, cost to income ratios probably much better position. I think these banks are in for a good time, specifically those who are catering to retail advances. So one really needs to identify these NBFCs into two buckets, take a bottom-up approach, see where valuations are looking still quite reasonable and where earnings growth can be sustained over the next 4 to 6 quarters.
Point taken, Mayuresh. Hold your thoughts. Let's focus on earnings. Now we are watching by and waiting by for Tech Mahindra numbers. The wage hike pressure is likely to impact operating margins, while cross-currency headwinds are also likely. Shell is here with what more can be expected from the IT giant. Shell?
Right, so when you're looking at Tech Mahindra, the company's revenues in rupee terms are seen up by 2%. The company's revenues in dollar terms are seen up by 0.6%. Whereas when you're looking at the company's profits this quarter, they are seen down by almost 3.4%. Also, when you look at the margins, they're expected to decline slightly. They're expected to come in at 16.6%. Few factors to watch out for when you're looking at Tech Mahindra. The first one is that a slight bit of pressure on margins is expected on the back of the annual wage hike bill. Besides that, also cost optimization measures are expected to go ahead and help the company. Vertically, when you're looking at it, telecom is expected to be a strong quarter for that segment. Enterprise growth is expected to be on the softer side. What are the 2 or 3 things to watch out for when you're looking at Tech Mahindra this time around? Outlook on the growth of the communications vertical. Any kind of outlook with the management gives out on margins, that will be important. And TCV of deal wins as far as the enterprise segment is concerned will also be quite important.
All right, thanks for those expectations, Shell. And as he was pointing out, it's expected to be an extremely muted quarter because there's hardly any growth even anticipated in terms of the dollar revenues, seen growing by around 60 basis points thereabouts. And the margin pressure, as Shell was highlighting, is likely to come by through the cross-currency headwinds, as well as the consolidation as far as the LCC revenues are concerned will also be looked out for, and also the under pressure telecom segment. Mayuresh, coming to you, the IT pack and especially the CNX IT index, and we'll talk about stocks as well, it was under the 20, 50, 100, 200 DMS. So there's a lot of selling pressure at the index level. I mean, despite the kind of, above par performance from Infosys or a TCS, there's no really material buying coming through as far as these names are concerned. How are you positioned as far as the IT pack goes?
Again, the top tier IT names have performed reasonably better. Within the top tier IT names, companies like Infosys have delivered both in terms of how the volume growth was expected to pan out, and the management commentary was very, very strong when it came to spending, and again the kind of synergies that they probably expected to deliver in terms of the expected turnover of $20 billion sitting on cash, expected tailwinds to come through from increased utilization levels. Some of the companies did disappoint, so Wipro probably came below par numbers. What happened with TCS, the management commentary was extremely strong, and they're expecting a huge amount of turnaround probably happening in their core business vertical. Diligent are probably expected to bottom out as far as their underperformance has continued. But largely, I think top tier IT companies, in my opinion, should do well on both counts, either in terms of the dollar or the constant currency revenues should be quite reasonable over the next 4 to 6 quarters. A lot of management commentaries have probably hinted to the fact that consumer discretionary spending has probably not slowed down. So I think the fear that you're probably talking about, or the street is expecting in terms of spending actually going down, is the other way around. I think there are a huge number of niche products coming through, whether that be big data, you're looking at cloud computing, you're looking at niche offerings, which will probably have support for the earnings. And again, I think utilization levels improving, attrition levels coming down. So I think Infosys and HCL Tech remain in our pecking order when it comes to the top tier IT names.
Right. Extension of that, Mayuresh, if you talk about some of these internet listing companies, for instance, an InfoEdge or a Just Dial for that matter, do you have any view on these two? If you talk about a Just Dial, possibly it has been late entrant in the Search Plus business, and even in terms of their omni-channel, the costs there are expected, for the upgradations and the scale-ups. Customer accretiveness is a matter which can be obviously taken into account, but the break-even and even in terms of revenue accretiveness, that seems to be quite a distance away from this point. What is your view on some of these companies?
Again, the management has indicated that the top line might be under some amount of stress, and though I think the entire theory that gets worked on is the kind of paid subscriptions that come through and the new platforms that they've launched, it is up to the next few quarters for the management to deliver, and they've front-loaded all their costs, whether that be employee expenses, the sales personnel that they have taken about. So that will largely ensure that the EBITDA margins probably remain constrained for the better part of FY17. What happens thereafter will be a mix of both these factors, how their platforms are doing, both GD Omni, their Search Plus application. These platforms need to deliver on the top line in terms of how their execution capabilities are panning out, how much of additions can they make in terms of the paid subscription base. And thirdly, I think in terms of how the earnings will pan out, because a lot of front loading will take place in FY17. FY18, if the top line and the volumes grow on the top line, I think that will straight translate into the bottom line. So largely, I think my own take is that stocks like these would underperform unless you get clarity in terms of a consistent earnings performance coming through.
Right. Let's focus on earnings. The numbers flashing at the bottom of your screen, and pull up Reddington India as well. The stock has seen a spike up intraday. If you talk about the total income, that has come in at around, it's a little higher. 8202 crores was the quarter ended 31st March 2015, and now it has come in at 10,474 crores. So that's a decent bump up. In terms of the operational profit, that has come in at 210 crores as opposed to 198 crores. So 12 crore jump in the operational profit. This is the PBIT number that is being spoken about. While at the bottom line, on the consolidated print, it is a loss of 6.2 crores. Pardon me, it's a profit of 143 crores as opposed to a profit of 122 crores. So there is a reasonable bump up that is seen, and if you exclude the minority interest, the profit is 137 crores as opposed to 122 crores. So on even the top line, operating line, as well as the bottom line, there's a moderate bump up that has been seen. The stock reacted significantly, but now is cooling down a little from gains of almost 2.2%, now is up around 1.8%. So that's Reddington for you. The profit is at 138 crores as opposed to 126 crores, and it's a tad above the estimates. Well, let's focus on the pharma space as well, and in keeping with earnings, after a strong show from Lupin, we are now watching out also for Cipla earnings. Hiral has been going through the street expectations. Hiral, Cipla also expected to report a healthy quarter.
That's right. Cipla is expected to post a strong quarter, mainly driven by growth in both domestic formulation business as well as the export business. Pulmicort as well as partial invasion integration is expected to drive Q4. In terms of the headline numbers, total revenues are seen up by around 8% at 3,334 crores. In terms of the profits, we are expecting a growth of around 37% at 355 crores. Margins are expected to expand and come in at 18.3% versus a 16.4%. And if you see in terms of the EBITDA, we are expecting a growth of close to 20% at 611 crores, and this is mainly led by a low base of last year. In terms of where factors are concerned, the domestic formulation segment is expected to register a 15% year-on-year growth. The export formulation business is expected to see a moderate growth, mainly led by full benefit of Pulmicort contribution as well as partial invasion integration. And adverse currency movement is expected to impact the South African performance as well. And the key factors that one will need to watch out for will be the management's commentary on the recently acquired Invasion plus Exelan consolidation and the US ramp up. Additionally, the update in terms of the potential launch of Seretide in UK, Pulmicort contribution in the quarter will also be watched out for, and their outlook in terms of the domestic market given the FDC ban as well as additions to NLEM list and their guidance for FY17. So all in all, a stellar quarter that is expected. However, the management's commentary will be a crucial thing to watch out for.
All right, thanks for those details, Hiral. Mayuresh, coming to you, what are you penciling in as far as Cipla is concerned? I mean, we have seen US FDA concerns that have been rife and playing out, even for Lupin for that matter, for their Mandideep as well as Goa facilities. But specifically for Cipla, do you have any numbers that you're working with?
No, again, I think largely what I'm expecting is 10% revenue growth. taking place. Yes, there would be some amount of hit when it comes to the South African business because of the cross-currency headwinds that Cipla will face. But largely, I think the margins, in my opinion, should come between that 14.5%, 15.5% kind of range. You're expected to see a steady improvement in margins over the next 4 to 6 quarters. What happens with the new key launches, both in terms of domestic formulations as well as export formulations, will be keenly watched out for. I think a large part of the Nexium benefit has come into Cipla's balance sheet. So it is up to the management to probably indicate what kind of approvals they're looking specifically in the CFC inhaler market, both in the United Kingdom as well as the United States of America. They've got a very strong ANDA pipeline. So again, I think the earnings growth should be quite reasonable over the next couple of years. But I think all these factors should be keenly watched out for. So I think numbers should be more or less within that range of 10% top line growth, though the margins are varying as per Bloomberg estimates. My own sense is that margins should be between 14 and 15%.
All right, so those are Cipla expectations for you. We're waiting by for those numbers later today. Let's see how those numbers pan out as far as Cipla goes, as also for something like a Tech Mahindra, the larger of the whole host of earnings that we're waiting by for in the second half in today's session. Well, moving on from pharma to FMCG, the bread available in India may be laced with toxic chemicals. The Center for Science and Environment, or CSE, found potassium bromate or potassium iodate in bread samples tested in products of popular multinational fast food outlets like KFC, Pizza Hut, Domino's, Subway, McDonald's, and Slice of Italy. We spoke with Amit Khurana of CSE, and he says that the FSSAI has already banned one of the chemicals on their report, and more action is likely to follow. Listen in.
If the residues are found, the countries have banned it. Now, we are at the same situation now in India. The law permits use of this as of today, but the residues are found. You can clearly see from our study, and we have been basically saying that both these chemicals should be banned. Now, the one good news here is that just yesterday evening we came to know that the Food Safety Authority has decided to ban the potassium bromate and evaluate the second chemical, potassium iodate, which is good. So we hope that something more positive would come on potassium iodate as well.
Mayuresh, coming to you with this, I mean, we have seen FSSAI concerns, and it has wreaked havoc on stocks. I mean, we saw what happened with Nestle, but in terms of this new concern that is emerging as far as bromate in breads is concerned, do you think it's only a sentimental move for now? Because at least the stocks are reacting negatively in today's session, the QSR names, even a Jubilant Foods for that matter. But do you think it's a long-term concern? Is it likely to be more protracted as the FSSAI comes up with more observations, and it'll be again a legal battle going ahead?
So again, largely I think not too sure at this point of time, and this will act as an overhang because what actions are taken either by FSSAI is going to be determinant on what kind of data that they probably get. So again, I think this might act as a deterrent or something like as an impediment for a lot of these stocks which are basically using these ingredients if they are. So again, largely I think one really needs to understand in greater detail what is going to happen. But at that point of time, my own sense is that the stocks might just sentimentally take a hit as they are taking today, unless you get further clarity. I think you need to wait for clarity happening from the regulator on this aspect.
All right, Mayuresh, we'll leave it at that. Thank you so much for joining us for today's session with your index view as well as a stock-specific and sector-specific opinion. Well, moving on now, Sterlite Technologies has completed the demerger of its power business into post-demerger. Sterlite